Hey everyone, Thomas with Basecamp Trading. It is Wednesday, May 6th, and we're going to talk a little bit about understanding compression and how to identify compression. So before we do that though, make sure you hit that like button if you haven't already done so, and subscribe as well. That way you can get alerted whenever we have new videos that we post here on the YouTube channel. So with that being said, let's talk a little bit about compression. So markets move through periods of expansion and periods of compression. What I mean by that is, if you look at this, for example, this chart here, you can see where our compression zones are, like here, and then our expansion zones here and here, compression zone, expansion zone, compression zone, expansion zone, expansion, compression. You get the idea. So where do most traders end up losing money? Well, most traders end up losing money trading inside of these compression zones, because that's when the market is not running. That's when it's chopping around. It's when people get in and get stopped out, get in and get stopped out over and over and over again, and they end up having kind of like death by 1,000 cuts. So one of the easiest ways of identifying compression versus expansion is by paying attention to the pivot points. All right, now when I say pay attention to pivot points, all pivot point is a big turning point in the market. Now we don't just want a single price bar up or down. What we want to see is several price bars up and several price bars back down. And what we will look for is we'll look for a market to pivot inside of the range of its previous pivot high and low. So for example, here, this is the S&P on a 120-minute price chart. You can see here's our pivot high, and then our high to low range is there to there. We went and bounced back up. So as we start to climb back up, what we watch for is if it pivots again before breaking this pivot high up here, then we'll say, okay, we're starting to be in compression. And we can do one or two things by that point. We can either draw our trend line going across the highs like I did here, or you can put a horizontal line at the highest point of your compression zone. And we'll say, okay, this market is staying in compression until we break out of the previous pivot high up here, or break below the previous pivot low. In this case, you can see we turned, we came back down, we came just about to the lows and turned, and we're starting to come back up now. Now we have not officially put in a pivot low yet in this case, because we have not had several price bars back up. It's just one bar down, and we're starting to climb back up, and this bar has not even come to a close yet. So keep that in mind. It's not officially a higher pivot low yet. So that's why I do not have a trend line drawn across these lows, because we only draw trend lines once we have an official pivot. So what we'll watch for in this case is the trend line going across our highs and then the support level at the previous pivot low. And we'll say, okay, our range here is from that high to this low, and we will say this market is compressing until we break out of this compression zone, and we either break through the highs and then we'll start going expansion to the upside, or we break through the lows and then we'll look for expansion to the downside. And while we're inside of the compression, we don't trade it, because that's a good place to lose money. All right, now you can apply this same type of analysis on any time frame on any market. For example, this is Tesla on a 30-minute price chart. So we went to an equity. We're looking at a 30-minute price chart. We can see here is our compression zone. Here's where we went expansion. Then we accelerated down. We went compression here, expansion up, compression here, expansion up, and now we're inside of compression yet again, waiting on our breakout of that compression zone. Same thing goes on back here. Market pulls down. We go sideways into compression. There's our compression zone. We rally into expansion and then go compression here again. All right, so you can apply the same type of analysis no matter what market or time frame you're looking at, whether you're a day trader, a swing trader, or a position trader. But one of the number one things you can do, in my opinion, to become a better trader and increase your probabilities of having winning trades is avoid trading inside of compression and trade more during these expansion phases, and that will help you with getting in when the market's actually moving and making you money, as opposed to trading and getting stopped out and having death by 1,000 cuts because of these small stop outs that happen over and over and over again while the market compresses. But that is going to be it for today, everybody. I hope it helps. Don't forget, once again, like and subscribe if you haven't already done so. And until next time, everyone, happy trading.